Most people are misreading the Clarity Act right now. The biggest obstacle isn't where most headlines say it is. And with the Senate facing a rapidly closing deadline, the outcome could influence crypto regulation and institutional confidence for years to come. In the next few minutes, we'll break down the real Senate vote count, the hidden negotiations happening behind the scenes, why Wall Street is paying attention, and what this could mean for XRP and the broader digital asset market. The dominant narrative has been simple. Democrats are blocking crypto legislation, while Republicans are trying to move it forward. But that's only part of the story. The real battle is unfolding inside both parties, where disagreements over ethics, regulation, and financial stability have created a far more complicated path than most investors realize. And that matters because this isn't just another political debate. The Clarity Act could become the legal framework that determines how digital assets are regulated in the United States for years to come, influencing everything from institutional participation to product development and investor confidence. The closer you examine what's happening inside the Senate, the clearer it becomes that this vote isn't just about crypto. It's about the future structure of the digital asset industry. Ladies and gentlemen, if you want the silent perspective on XRP and crypto and want to cut through the daily chaos and noise, subscribe. I break it down simply so you can see what actually matters in the markets. If you followed recent coverage, you've probably heard one dominant narrative. Democrats are blocking the bill. It's a simple explanation. It's easy to understand, and it's only partially true. Because the biggest obstacle may not be across the political aisle at all. It may exist within the Republican Party itself. This is where the story becomes far more interesting. The United States Senate requires 60 votes to advance legislation like this. Republicans currently hold 53 seats. At first glance, many observers assumed that strategy would be straightforward. Keep Republicans united, then persuade 7 Democrats to join them. Simple. Except politics is rarely simple. Several Republican senators have publicly expressed concerns about the current version of the legislation. Some disagree with specific provisions. Others believe the bill doesn't accurately address broader financial concerns. That means Republicans may not even begin negotiations with their full 53 votes. If support starts below that number, every additional vote becomes significantly more valuable. Suddenly, the challenge isn't convincing 7 Democrats. It may involve rebuilding support inside the Republican caucus before reaching across the aisle. That's a completely different political landscape, and one that many headlines barely acknowledge. But here's where it gets interesting. The same issue creating problems for Republicans may also be the key to attracting more Democratic support. Political battles often revolve around a handful of influential figures, not necessarily because they hold the most power, but because they serve as a bridge between competing groups. One of those figures in the Clarity Act negotiations is Senator Tom Tillis. For months, Tillis was expected to play a crucial role in negotiating ethnic language that both Republicans and Democrats could accept. He wasn't simply another vote. He represented an opportunity to build consensus. So when he indicated that he could not support the current version of the bill, it immediately changed the political calculations. Think about it this way. Imagine trying to complete a puzzle where one of the connecting pieces no longer fits. Every surrounding piece suddenly becomes harder to place. That's what happened here. Tillis' position signaled that the challenge wasn't merely about adding Democratic votes. It highlighted unresolved concerns within Republican ranks as well. In Washington, perception matters almost as much as numbers. Lawmakers consistently assess whether legislation appears to be gaining momentum or losing it. They believe a bill is strengthening, they're often more willing to negotiate. If they sense momentum is fading, some become reluctant to attach their names to it. That doesn't necessarily determine the outcome, but influences the negotiating environment. And right now, both sides know that every public statement sends a message beyond the Senate floor. One of the biggest mistakes investors make is assuming that silence equals opposition. In financial markets, silence often creates uncertainty. In politics, silence can be a strategy. Patrick Witt, who has closely analyzed Senate voting behavior, has argued that many senators intentionally avoid revealing their final position before a vote. Why? Because public commitments reduce negotiating power. If the senator announces support too early, they lose leverage. If they publicly reject the bill, reverse course later becomes politically awkward. Remaining undecided votes for flexibility. It allows lawmakers to continue negotiating until the final moment before legislation reaches the floor. That's why predicting Senate outcomes can be so difficult. Television interviews don't always reflect private conversations. Press releases don't necessarily reveal ongoing negotiations. Even strong public criticism could sometimes serve as leverage to secure amendments rather than signal permanent opposition. This makes the eventual floor vote unique. It's not simply that moment when senators make a decision. It's often the event that forces the final negotiations to happen. In other words, the vote itself becomes part of the negotiation. Now, this is what most people miss, unfortunately. Political observers often spend weeks trying to count public supporters. But some of the most important decisions aren't made in front of television cameras. They're made in private meetings, hallways, conversations, and last-minute negotiations that continue until the vote begins. History shows that major financial laws rarely follow a straight line. To understand why this process feels so unpredictable, it helps to look backwards. In the late 1990s, the United States debated one of the most significant financial reforms in modern history. For decades, the Glass-Steagall Act had largely separated commercial banking from investment banking. Supporters believed those boundaries promoted financial stability. Critics argued they prevented American financial institutions from competing effectively in increasingly global marketplace. The debate lasted for years. Negotiations shifted repeatedly. Lawmakers disagreed over details that seemed technical but carried enormous economic consequences. By the time Congress approved legislation repealing major portions of Glass-Steagall in 1999, the final compromise looked very different from any early proposals. Support had changed. Language had evolved. Political alliances had shifted. Regardless of where someone stands on the long-term consequences of that decision, one lesson remains remarkably relevant. Major financial legislation almost never moves in a straight line. The version introduced isn't usually the version that becomes law. Compromises emerge. Oppositions change. Amendments reshape the final outcome. Today's crypto legislation appears to be following a similar pattern, not because history is repeating itself exactly, but because complex financial reforms almost always involve prolonged negotiation before reaching consensuses. The ethics debate could change everything, ladies and gentlemen. Among all the issues surrounding the Clarity Act, one has become particularly important: ethics enforcement. Several Democratic senators have argued that the current language doesn't provide significantly strong enough mechanisms to ensure accountability. Supporters of strong enforcement believe regulatory clarity should be matched with robust oversight. Otherwise, they argue bad actors could exploit legal certainty without facing adequate consequences. One proposal attracting significant attention would expand enforcement authority beyond the Department of Justice. Instead of relying solely on federal prosecutors, state attorney generals could also receive enforcement powers. At first glance, this sounds like a technical legal adjustment, but politically, it become one of the most significant changes in the entire bill. Why? Because it addresses concerns from multiple directions. Democrats seeking stronger consumer protections may view broader enforcement powers as a meaningful improvement. Some Republicans focused on legal clarity may still support the legislation because the core regulatory framework remains intact. That doesn't guarantee agreement, far from it. But negotiations often hinge on identifying changes that allow different groups to support same legislations for different reasons. And this proposal has emerged as one of the strongest candidates for exactly that role. Sometimes the smallest changes unlock the biggest political shifts. Sometimes they don't. That's why investors, lobbyists, and industry leaders continue watching every amendment just as closely as they watch the vote itself. The banking industry isn't speaking in one voice. While lawmakers debate ethics and regulation, another conversation has been unfolding in the background: the future of banking. One concern raised by some Republican senators centers on stablecoins. The argument is relatively straightforward. If consumers increasingly move money into stablecoins instead of keeping deposits inside traditional banks, banks could lose an important source of funding. On paper, that's a legitimate question worth examining. Banks rely heavily on customer deposits to support lending and other financial activity. Large shifts in where consumers store money naturally attracts attention from policymakers. But the story doesn't end there, because the banking industry itself appears far from united. Some institutions have expressed caution. Others have quietly invested billions in blockchain technology. Several major banks are exploring tokenized deposits. Others are researching digital settlement systems. Some are preparing crypto custody services. In other words, many of the same institutions expressing concern about digital assets are also investing substantial resources into digital finances. That apparent contradiction has fueled an important debate. Are banks primarily worried about financial stability, or some concerned about increased competition? Those two questions aren't necessarily mutually exclusive, but both could be true at the same time. But recognizing that distinction is important when analyzing the political debates surrounding the legislation. After all, industries often adapt to technological change, even while lobbying to shape the rules governing that change. While much of the debate has focused on politicians, another influential voice has quietly entered the conversation: Wall Street. One of the most notable developments came when Goldman Sachs CEO David Solomon publicly called for greater regulatory clarity around digital assets. That statement carries weight, not because Goldman Sachs alone can determine the future of crypto, but because it reflects a broader institutional reality. Large financial firms rarely commit billions of dollars to products that exist in legal uncertainty. Before launching new services, institutions want to know which regulators oversees them. They want clear compliance requirements. They want predictable rules. Without those ingredients, even firms interested in blockchain technology often slow their investment plans. Wall Street's signal may matter more than many expect. While most of the public debate has focused on politicians, Another influential voice has quietly entered the conversation: Wall Street. One of the most notable developments came when Goldman Sachs CEO David Solomon publicly called for greater regulatory clarity around digital assets. That statement carries weight, not because Goldman Sachs alone can determine the future of crypto, but because it reflects a broader institutional reality. Large financial firms rarely commit billions of dollars to products that exist in legal uncertainty. Before launching new services, institutions want to know which regulators oversee them. They want clear compliance requirements. They want predictable rules. Without those ingredients, even firms interested in blockchain technology often slow their investment plans. This is why many analysts view regulatory clarity as being just as important as favorable regulation. The goal isn't necessarily fewer rules, it's clear rules. That's a distinction that often gets overlooked. Supporters of the Clarity Act argue that certainty could encourage more institutional participation because firms would finally have a defined legal framework within which to operate. Critics counter that the framework still needs stronger safeguards before it can achieve that goal. Those are fundamentally different arguments. One side focuses on speed, the other focuses on oversight. The challenge for lawmakers is finding a balance that satisfies enough senators to reach the required 60 votes. But here's where it gets interesting. Markets don't always wait for legislation to pass. Sometimes they begin reacting to the likelihood of future policy long before their final votes ever take place. Politics isn't governed only by votes. It's governed by time. And right now, time may be the greatest obstacle facing the Clarity Act. Reports indicate that the legislative text became available only a few days before the Senate's planned August reset. That created an incredible compressed timetable. Think about everything that needs to happen before a major financial bill reaches the floor. Senators must review hundreds of pages of legal language. Their staff must analyze potential consequences. Industry groups provide read feedback. Lobbyists suggest amendments. Party leaders count votes. Compromises are drafted. Lawmakers negotiate changes. Every one of those steps takes time, and time is exactly what negotiators now have very little of. Some observers have described this as a self-inflicted challenge, not because compromise is impossible, but because even the best compromise still requires enough time for lawmakers to evaluate it. As the deadline approaches, pressure builds on everyone involved. Supporters want to vote before momentum fades. Opponents may calculate that delay improves their negotiating positions. Undecided senators gain additional leverage simply because their votes become increasingly valuable. In many ways, the deadline itself has become another participant in the negotiations. Let's separate the immediate headlines from the longer-term implications. If lawmakers ultimately approve the legislation, it would not instantly transform the cryptocurrency market. It wouldn't automatically send Bitcoin soaring. It wouldn't guarantee that XRP or any other digital asset experiences a sustained rally. Markets are far more complicated than that. However, supporters argue that a successful vote could remove one of the industry's biggest structural obstacles: regulatory uncertainty. Companies considering expansion in the United States could have a clearer roadmap. Financial institutions might find it easier to develop compliant digital asset products. Developers could spend less time wondering which regulator has jurisdiction and more time building technology. That's the difference between price and structure. Prices react quickly, structures shape markets over years. As we've seen throughout financial history, legal frameworks often outlast market cycles. Bull markets often come and go, bear markets come and go. But the rules governing an industry can influence investment decisions for decades. That's why so many institutional investors are watching this legislation, even if they aren't active participants in today's crypto market. They're looking beyond tomorrow's headlines. They're looking at the next chapter of financial infrastructure. History provides another useful perspective. In 1971, the United States ended the Bretton Woods system, effectively bringing the dollar's direct convertibility into gold an end. The immediate reaction was uncertainty. Currencies became more volatile. Investors questioned what the future international monetary system would look like. The headlines focused on short-term disruption, but over time, the more important story became structural change. A completely different monetary framework emerged. Global finance adapted. Markets evolved. Whether someone views that decision positively or negatively isn't the point. The lesson is that the last financial reforms often create uncertainty before they create stability. The same principle can apply to modern regulatory challenges. The biggest impact isn't always visible on the first day. Sometimes it gradually unfolds over years. I want you to imagine building a medieval stone bridge. Construction didn't begin with the final arch. Workers first laid foundations that nobody celebrated, stone after stone, layer after layer. Most people walking past probably couldn't imagine the finished structure. Only once the keystone was placed did the bridge become fully connected. Regulatory clarity works very much in the same way. Individual laws may not create immediate transformations, but each one can become another stone supporting a much larger financial system. Crypto's long-term development may depend less on dramatic headlines and more on gradual construction of legal infrastructure. Among all the digital assets communities, XRP holders have been especially focused on regulatory developments. That's understandable. Fewer cryptocurrencies have spent as much time at the center of legal discussions in the United States. For years, uncertainty surrounding regulation has influenced how many investors evaluate the asset. The Clarity Act isn't designed specifically for XRP, nor does it resolve every legal question facing the broader industry. But many market participants believe that a clear regulatory framework could improve confidence across the entire digital asset ecosystem. That does not mean prices must rise. Markets depend on countless variables: macroeconomic conditions, interest rates, institutional demand, global liquidity, investor sentiment, and geopolitical developments. Legislation is only a piece of that puzzle, but it's an important piece. As the old saying goes, markets dislike uncertainty more than almost anything else. Whether optimism or caution ultimately proves correct, investors will finally have more information once lawmakers reveal where they stand. Think of today's regulatory debate like the construction of a Roman road network. A single road didn't transform an empire, but every new connection made trade easier, communication faster, and economic activity more efficient. Eventually, those individual roads formed an interconnected system that supported centuries of commerce. Crypto regulation could follow a similar path. No single piece of legislation will determine the industry's future, but each layer of legal certainty can make the next stage of the development easier. The industry isn't built through one vote. It's built through many decisions that gradually create bigger confidence. So where does all this leave us? The public narrative has focused heavily on partisan politics. The reality is much more nuanced. Republicans are working through internal disagreements. Democrats continue pressing for strong enforcement mechanisms. Major financial institutions increasingly want regulatory certainty. Banks remain divided over the long-term implication of digital assets. And the legislative calendar leaves almost no room for delay. That's why predicting the outcome remains so difficult. There are genuine paths towards compromise. There are also genuine obstacles that could prevent a deal from happening before the Senate recess. Both realities exist at the same time. For investors, that means distinguishing between what is known and what remains uncertain. We know the vote threshold. We know the concern raised by lawmakers. We know institutional interest in clear regulation continues to grow. What we don't know is where enough senators will ultimately support the final version of the bill. See, whatever happens next, one thing is becoming increasingly clear. The Clarity Act has evolved into far more than a debate around cryptocurrency. It's become a test of how the United States intends to regulate one of the fastest growing areas of modern finance. The eventual vote, whenever it comes, will reveal more than whether a bill passes or fails. It will show which lawmakers are prepared to support a long-term regulatory framework for digital assets and which believe more work remains before the framework is ready. For the crypto industry, for Wall Street, and for investors around the world, that information could prove just as valuable as legislation itself. Because while prices may react in the short term, the structure of financial systems evolves over the long term. If you enjoyed this breakdown and want more in-depth analysis on crypto, macroeconomic, and the forces shaping global finance, make sure to subscribe and turn on notifications. The next few weeks should become one of the most important periods for digital asset regulation in years. We'll be here to break down every major development as it happens. Thank you for watching. I'll see you in the next video. I love you all.